The hedging toolkit inside most institutional portfolios was designed for a world that is actively disappearing. Not slowly, not eventually, right now. Santiago Capital just published a paper called The End of Peacetime Portfolios, and its central claim is one that should keep every long-term investor awake tonight. The option strategies, the VIX products, the variance swaps, everything professional money managers use to manage tail risk, all of it rests on a single assumption that almost nobody says out loud. The assumption is that things mean revert, that after a shock, the world snaps back, that the Federal Reserve, the dollar system, and the multilateral trade order provide a permanent floor beneath which things do not fall. Brent Johnson, the ex-Credit Suisse strategist who created the Dollar Milkshake Theory, argues that assumption held from 1945 to roughly 2020. It is not obviously true today. In the next few minutes, I am going to show you the data behind that argument, what happened to investors who ignored similar warnings in the 1930s and 1970s, and the specific portfolio framework Santiago Capital says you should be building instead. One chart in this paper stopped me cold. I will show it to you in a moment. Here is what is actually happening. Think of the global economy like a house with load-bearing walls. For 75 years, those walls were multilateral trade agreements, dollar-denominated energy markets, open shipping lanes, and a shared understanding between nations that free trade was better than the alternative. What Santiago Capital has documented across 6 separate research papers over the past year is that those walls are being removed, not by accident, by policy. The Trump administration's trade framework is not a negotiation tactic. It is the systematic replacement of multilateral agreements with bilateral deals built on leverage and coercion. Supply chains are being deliberately fragmented. Energy markets are being weaponized. American carrier strike groups are repositioning near the Strait of Hormuz. Every single election across Latin America in 2025 was won by a right-leaning candidate oriented toward Washington. China's 2 decades of patient infrastructure investment in the Western Hemisphere is fracturing, and the dollar is not just defending its reserve currency status. It is extending it into digital rails through stablecoins. These are not independent events. They are one machine with many moving parts. And that machine is dismantling the architecture your portfolio was built on. Now let me show you the numbers, and I want you to really sit with these. During the 1970s stagflation, gold rose approximately 2,000% in nominal terms. In that same period, the classic 60-40 portfolio, 60% stocks, 40% bonds, lost roughly 40% in real terms. Look at this chart. The divergence is enormous. An investor who held gold preserved and multiplied their purchasing power. An investor who trusted the standard institutional playbook watched their wealth quietly evaporate against inflation. Now look at this one. The Nikkei 225. An investor who bought Japanese equities at the 1989 peak waited more than 34 years just to get back to the same nominal price. In real terms, adjusted for inflation, they have never recovered. That is not a dip. That is a permanent displacement of the mean. And that is exactly the distinction Santiago Capital is making. This chart compares 6 discontinuity risk indicators between 2015 and 2025. Trade fragmentation, kinetic conflict risk, debt to GDP ratios, all of them have gotten worse. Every single one. The prior equilibrium you are waiting to return to may no longer exist. And here's the question almost nobody is asking. What does this mean for your money? So what do you actually do with this information? Santiago Capital is not saying sell everything and hide in a bunker. They are saying the base case for most institutional investors right now, effectively zero discontinuity insurance, is not a neutral position. It is an active bet on peacetime. And in the environment we are living through, that bet deserves to be made consciously. The paper lays out a specific framework. Look at this regime assessment table. First, physical gold, not a gold ETF. Physical gold. It worked in the 1930s. It worked in the 1970s. It is the only asset class that has reliably preserved purchasing power through every wartime discontinuity in modern history. Second, commodity-producing real assets. Think about companies and land that produce the things a deglobalizing world cannot live without. Energy, agriculture, critical minerals. Third, geographic diversification away from assets that depend entirely on the old multilateral order functioning. And fourth, strategic short exposure to hyper-globalized business models, companies whose valuations still assume frictionless global supply chains, free trade, and cheap overseas labor. The world those companies were built for is the one being dismantled. The cost of carrying this insurance in a world that muddles through is manageable. The cost of being uninsured in a world that breaks is not. There are really two scenarios from here. In the first, the world muddles through. Trade tensions ease, institutions hold. The Federal Reserve maintains credibility, and the investors who bought discontinuity insurance paid a small premium for protection they did not need. That is the cost of being wrong with this framework, a manageable insurance premium. In the second scenario, the regime change accelerates. Trade fragmentation deepens. A kinetic conflict erupts. The dollar system faces a real challenge, and the investors who held gold, real assets, and geographic diversification are the only ones left standing with their purchasing power intact. That is the cost of being wrong without this framework. It is potentially permanent. Santiago Capital is not predicting doom. They are pointing out that the current environment looks considerably more like the preconditions for wartime discontinuity than anything we have seen since the 1970s, or in some respects, since the 1930s. That is not a comfortable conclusion, but it is the honest one. This is the kind of research that changes how you see markets, not for a day, for a cycle, for a generation. Brent Johnson spent his career at Credit Suisse and BakerAvenue. He created the Dollar Milkshake Theory, the framework professional macro investors now use to think about the global dollar system. His research at Santiago Capital is the same caliber that family offices and fund managers pay for, and it is available to you. Right now, paid subscribers get 2 institutional-grade deep dive reports every month, 2 live Q&A calls with Brent himself, and a lifetime rate lock. Your price never goes up, even as the platform grows. Every month you wait is a month of research you will never get back, and a month closer to the next price increase. Go to research.santiagocapital.com. Start free if you want a taste. Go annual at $399 a year if you are serious. Go pro at $2,399 per year if you manage money. The link is in the description. Don't miss the next one.